Buddy, this is Michael Sadaka from Minyanville. I'm here with Kevin Ferry and Vince Foster, two masters of the universe in the interest rate world. And we'll be talking about the curve today, some wine hopefully, since we have someone out there in California today, out in Napa, and hopefully learn a few things about where the market will end up here in the next 6 months. We had these guys on 6 months ago in December, and they called for the curve to flatten dramatically, and here we are about 8 months later, and it's a lot flatter. So afternoon, guys.
Hey.
Hi,
thanks for having us back.
So we have the first chart here. Let me get it popped up. There we go. So the first chart, Vince, you want to explain this one? It's of the Federal Reserve growth, and
it's reserves held the Fed for banks. That's the growth rate of the reserves over the 5-10 spread, and basically I look at it from a very simple standpoint, and how the curve is essentially, and they use 5s, 10s because it's in the middle and it's not as much. With 2s kind of pinned at 0, I think it gives a better reflection. But essentially, the way I look at it is the curve is a manifestation of the market's inflation risk premium, and I'm not talking about CPI risk or pork belly risk. I'm talking about the monetary, money in the system risk, and more money than there is demand. And so obviously, when the Fed is pumping all these reserves into the system, there's a tremendous amount of inflation uncertainty. So therefore, the market commands a higher risk premium for term structure. So that's what produced the historically steep curve. You can see back in 2011, and then when they cranked, when they went into Operation Twist, the reserve growth subsided, and so the curve fell, and then QE3 started up at the end of 2012, and growth kicked back up again, and so did the curve. So, and this wasn't just a post-financial crisis, phenomenon. This happened back in the 90s as well. And when the Fed got tight, the curve would flatten as inflation premium came out of the curve, and vice versa. And it's not a perfect. That's kind of in the 80s and 90s, and it's not a perfect relationship you can see. But back then, they Greenspan, and Kevin's could speak more to this, but Greenspan controlled the reserve growth more with the Fed funds rate. Am I right about that, Kevin?
Right. And the key difference, and the uniqueness of the spread in the first chart, Vince, that you and I have talked, is that you now have a Fed that pays interest on excess reserves.
Right.
And I think when they did that, even though back in the crisis, I was one of the people who was on CNBC advocating that they do this, maybe we didn't get the message across at the time that you are by definition a debilitated Fed or debilitated central bank when you have to offer interest on excess reserves, right? There's a reason for it. And those last few years, the post-crisis years when they're offering that are the key distinction, because now that reserve growth is distinctly tied to the balances that the Fed is creating at those banks.
Yeah, well, and I think there's so much focus in the media about what bonds they are buying, and what is that doing to the market? Is that goose in the stock market and all that stuff? And to me, it's more about the reserves. It's more about the liability side of the balance sheet that the market, kind of the invisible hand of the bond market, seems to care about. And so to that point, going into this year, when we were talking last December, it was like, okay, the taper is about to commence, and that means the growth in excess reserves has peaked, probably forever, right? Because there's not going to be any more excess reserves growth in excess of what happened at the end of quantitative easing. So while they're still buying bonds, the growth rate has peaked. Therefore, the idea was, okay, now the curve is going to start taking back some of that inflation premium, and whether or not that was going to be in the front end with rates moving up or in the back end with rates moving down was not as material as the slope, I think, the direction of the slope.
Right. Well, yeah, that's not not as material being a euphemism for me being completely wrong about where the rate structure would be. But, because the 10-year is still where I said or felt that the 5-year should be.
Right.
That doesn't necessarily change because now we're further on up the road, and the real question is, and why you've seen this become a hot topic is, have we entered into this new Larry Summers type of area, right? And I would push back against that thought. In fact, I would be more willing to entertain the idea that it's not anything new. We have returned to a pre-60s environment for rate structures around the world, right? And so if there is going to be an interest rate blow-up, then why do people keep thinking it's going to come from America? It's far more likely that it's going to continue to come from somewhere else. I mean, that people talk about, the United States, as I said, the 10-year has been about 252 since we talked. So England's 260, Germany's 1.15. That puts Ireland at 226, 225 today, right? Well, the whole European thing blew up because people were in the EU, right? They were mistakenly pricing the rest of Europe as if it was Germany, right? Well, they don't do that anymore. They just put a spread between the two, but the rates themselves are ridiculously low, right?
And their central bank is trying to devalue the currency, where ours is exiting. I mean, to me, that provides a lot of support for the back end.
Right, they've got issues with their own, right, and how they've not tackled them as openly as us. But again, from naysayers, myself included, but at least trying, not pushing against the trend, is to say, well, is the 10-year note in the United States really out of whack? Why do we all believe that it should be higher, right? And certainly there are multiple other countries or bonds that look like they might be more of a place that is mispriced than the 10-year note on the basis.
Well, and as I was talking to Michael about it, I think to your point about getting the level wrong. I mean, to me, it probably boiled down to one simple thing, and that was mortgage credit demand. And had mortgage credit demand held up in that 100 basis points higher rate regime from 1.5 to 2.5 or to 3%, you would have seen the front end back up because of the demand for credit. But the mortgage supply has completely gone away. It's running half what it was running, the previous 2-3 years. So it's very hard to see how the 10-year yield could back up materially in an environment where there's no supply of mortgages.
Right, and the taper tantrum, or the effect of the taper tantrum last year was severe.
Yeah.
And it showed up right on time 4 months later in the data.
Yeah, that's right. I mean, I think that this has shown is how sensitive, the market was proved to be sensitive to the cost of money. And I think one thing, we could debate about Fed policy errors or not, but I was, to me, if they probably should have never gotten into the mortgage market, because once they pushed those rates and yields to so low, and everybody had already refinanced that had the opportunity to refinance. So what they did is everybody refinanced again at another 50, 100 basis points below, and now no one wants to move, right? There's, no one wants to, you've locked in this insane mortgage that you're never going to get again, and now you just say, okay, well, I'll sit tight, and I'm happy with my 2.5% 30-year mortgage rate.
Right, and it's common from a cycle standpoint for people to continue to look at the last crisis as going to be the germinated seed of the next one. Well, I just don't think about shelter anymore. I mean, I don't even call it housing. It's shelter, and for the vast majority of Americans, that's what it is again. And certainly,
it's not an asset class anymore, is what you're saying.
Right. I mean, and so I just don't think the lightning doesn't strike twice in the same place. And so if there is a risk coming that we don't know, it's certainly not going to come where everybody's looking. And it's certainly not going to come from mortgages from a standpoint that everybody's looking at something that's in dwindling out of supply.
Yeah, I mean, if you look at what Michael put up.
That opens up other places. But.
Yeah. Michael put up the agency mortgage-backed security pool issuance, which you can see in 12 was 1.7 trillion, and 13 it was 1.6 trillion, and this year through month 7 we're at 464 billion. That's a material drop-off in supply.
Right, and the same thing for net supply. It's only going to be about 20 to 40 billion this entire year, and was 600 billion in the last couple of years.
And so, I mean, so Kevin, I mean, let me ask you this. I mean, we'll assume there would be a little bit of a freak-out factor, but I mean, if you're the Fed and you need to dwindle down reserves in order to truly, kind of tighten policy, assuming that's the objective, why wouldn't you just let some of these mortgages back into the market?
Right. Well, I mean, what you mean, sell them?
Yeah.
I guess to who? I mean, this is kind of why I think, if there is a problem, it's just because, again, late cycle, people, and you could see it as geopolitical stuff started banging around in the last month, right? I mean, you had a lot of people going on television telling them there was a flight to quality because they bought the Ultra bond. Well, they sure went to a different school than I did, because when we were in the 1980s, you bought the shortest piece of paper that was the closest thing to cash you could find, and you hid under your desk. You didn't buy the longest piece of paper. So the world.
You think if there was a true flight to quality, you would have seen the Death Star participation
leap.
Yeah.
Leap. Because now you have this counterparty that didn't even exist yet in a virtually risk-free cash transaction, right? At least you got 5 instead of 1 in the bill market. But so that just speaks to the cycle change. I mean, don't get me wrong. I still believe that the bond bear market started 2 years ago when we said it did. And this is a difficult phase, but tops are long and protracted things, and they can chunk along a lot longer than people are willing, or carry will make it available for you to sit there with your short, right? Mm-hmm. This is why, as a trader, Tudor Jones said, "Don't tell me why, tell me when." And so, I think that's the phase of the cycle. But again, it is common from a big cycle standpoint that people's mindset about the security or ability to own long-dated fixed income securities becomes embedded in the psychology, right? I mean, that's where we're at. That's where we're going, right? Even before, when we spoke 6 months ago, you'd buy the 5 before the Ultra bond, unless you were playing some duration thing, right? And that's why it fell apart so hard. So this year of putting people back in there is really critical. And so the question, I think, isn't that 530s is flat, that the Eurodollar curve has collapsed from 2015 versus anything behind it. But who are these people that so confidently go out and buy gold and purple Eurodollars? You know what I mean? I mean, you used to have to get managers' approval to even ask for a quote back.
Well, do you think that's West Coast money manager that's doing that has confidence in the in the rate outlook, or in the lower terminal?
And people like them. I mean, because the reality is, no matter how much they, I was laughing with Michael earlier. Rick Santelli's on TV today, getting excited about the fact that the 10-year note moved 3 basis points. I said, it's in the same year. It's been at 250 plus or minus 3 for as long as you can remember.
Yeah, I mean that was something that I noted, maybe a couple of weeks ago, is that we had this taper tantrum in the bond market, and the 10-year and the long bond essentially went straight to where they have been for the last 12 months. It's almost like they knew exactly where they were supposed to be.
Right. So that stability has morphed, now into the psychology that as long as there is stability, then you can do that trade, right? I think that's what we're getting at with regard to, there we go. How do you like me now? So, but you need a lot of confidence in the idea, or what they call selling quick. And when you talk about West Coast money managers, these guys are out here telling people to sell that volatility. I mean, they're down to they're not even picking up nickels anymore. They're picking up pennies, right, to hold on to that stability. And so, I mean, I wish I could tell you I was confident that it was going to change. But, well, you know, as Mike moves down his agenda and we talk about what we think is in store for the Fed, I wouldn't necessarily feel, I don't feel that that's something that I would be waiting too anxiously for just yet.
Well, and you bring that up, and in the last minutes of the last Fed minutes, they brought up that there's too much stability within the interest rate market when that's exactly what they want. To me, that was very confusing why they would say that when that is the number one thing they want, is to tell the market where rates should go. And then when the market finally said okay, they're like, all right, well, you guys are way too complacent.
Yeah, we want you to be fully right, accepting of stability, but fully hedged for the possibility that something might go wrong.
Yeah, don't lever up.
Don't lever up, right? So I don't see that happening. You know, from a psychology standpoint, you get what you deserve. But I would just say it'll come from left field. It won't come from the traditional places here in the States that people are, you know, thinking or worried about, i.e., the rate or what the Fed making a mistake. So yeah, if you want to talk about or ask what you were going to talk about, the Fed, Mike, this is a good time to talk about.
Sure. I mean, I suppose it seems like just about every single central bank in the world now has a financial stability mandate, and the Fed is going to be now the one that's explicit, but everyone else is more not so much explicit. You know, with the Bank of England, when even though they came out a few weeks ago with Carney, and then even though he said we wanted to shock interest rates some, they may have gone too far, and they had to go back immediately. And it's the inverse now with the ECB in China and Japan.
Right. So you have this big dichotomy, especially, you know, between the developed world, the developing world, and the frontier world, right? Which didn't exist before when we were all just on the metal to the metal together. And so again, if you talk big cycle, then I would say the first thing that went through with the whimper yesterday, besides guys who were trading the currency cross, was New Zealand. New Zealand and Australia are noticeably, you know, changing. They tend to be out in the front of curve of central bank moves as they go around the globe. And you saw what happened in the Kiwi after it took place anyway, right? So the real question is, now that we're fully priced for the Fed, or fully, at least even if slightly mispriced, fully anticipating the concept of the Fed moving in the first quarter of 2015, the question that people should be asking is, how would they move? Why would they move? And how would this, now that they've reestablished the Fed funds rate as their operational tool, how they're basically admitting that they can't control the supply and the price of the quantity and the price of their good at the same time. And so they are opting to create a spread between those two things, what the reverse repo facility, which we've affectionately called the Death Star, and the funds rate. And that's really the message that they were trying to get out at the last meeting. Vince and I, at least I was under the impression that a spread of a couple of basis points might be necessary. But yeah, to embed a spread of 20 is to really...
They're basically, I mean, I don't know if this is because they were really afraid of the disintermediation aspect that Dudley kind of talked about, but I mean, clearly they have no intention of taking the reserves out of the banking system, right?
They're going to have to let them leak out, run down. That's the key. And so what Michael was asking was, do we agree with the idea of rates going up in the first quarter? And I was like, well, if the market was demanding it. And the difference, for all the talk about the Fed meeting or the last two Fed meetings about when they might tighten, the question that should be asked, or the question I'm sure is being, the idea that's being discussed at the meetings is, show me the place in the term structure of interest rates in the United States of America that is demanding the Fed hike the rate. And it's just, It's not there, folks. And as close as we were to being there was last fall when we talked.
Right.
If the Fed wanted a free pass, and that's when they could have got it, or had it. But they didn't need it. See, that's the key, right? They didn't need it, and they didn't want it. And so when
but Kevin, I mean, you'd be the first to admit they know that, though, right?
You bet they do. And so I think that's why they pushed back verbally against where the market was trading. Maybe too late for some of us who had bought already, or too soon in that disaster. But the key being from a policy standpoint is, why would they charge themselves more to begin this process of getting towards the door? And I think that's the difference, right? They can either hike the IOER rate, or they can raise the Death Star rate, or they can just flat out raise the fund rate. But all those things are increasing the cost of them doing business while they're going through the process.
Yeah. Yeah, it's the old. I mean, they're paying through the offer price, right? I mean, they're going to pay more for money that's already there at a lower price. Why? For no reason other than just to do it, to say we're doing it.
To say we're doing it. And critical to that idea of what they're paying is the banks don't want it. See, the Fed believes, correctly or incorrectly, that they are not going to allow the system to bid for deposits and create a squeeze. Right? So they control that side of it. But at the same time, we're now entering into a world in which the receivers of those deposits don't want them. So why would they bid for them?
Yeah.
In fact, they want to shed them, right? And the Death Star creates a place where if the rates are attractive enough, right, and that's why the Fed calls around and asks, where would you guys play more, right? And because it gives them a place that is a virtually risk-free, or it is risk-free place to go do this. And that's why I think they've backed away from it. And so if you want to talk about something that I think could occur and would be completely different than any other cycle that we're used to, we're talking about, is that if the rate hike were to occur in the first quarter of 2015, it would look like this. And the Fed would say, the range for Fed funds is now 12 basis points to 37 basis points. And have at it.
Yeah.
And so the market would price the ZIRP at 25 as best it could, and the Death Star would trade right where it's at. And so the real question is, banks would pay a bit if they want, to the extent that they wanted the deposit, they would simply just top tick the Death Star. They could just be at the top. Exactly. Yeah. The real question is, would they really want to do it, right? Because, right, but it still could create a stability. You know, I don't know what the market does with that. I mean, you know, I'm sure they would have started to say, oh, it's going up. Let's start moving things in front of them, right? And then that activity would slow down.
So, I suppose the next question is, and I believe it was Yellen said in one of her recent speeches, they want to use the interest on excess reserves rate, which is a deposit rate rather than a lending rate. How can they use that as their main policy tool when that would be it doesn't make a lot of sense?
Well, yeah, and they also always couple it with a little softer statement at the same time, Mike, that sounds something like this. But don't call it a subsidy.
Yeah.
Because again, as Vince calls, the optics of this, it's really stupid, right? Let's take and especially when guys are saying, you know, in the Taylor rule guys, and Taylor, you know, with his rules saying, oh, let's take it to 4. Well, yeah, there's nothing like a risk-free 4% mark up the balances of the banks at 4% and just give them that. Well, that's ridiculous. Why would they do anything else? I mean, the Death Star already, they've already realized that they were, before they embedded this spread, that they could be creating something that was just a massive trading machine between the Fed counterparties and the Fed. And I don't know where the rest of the economy fits into that game, right? The economic consequence of those overnight transactions with each other is zero.
Yeah, I mean, the money doesn't move, right? It just moves in the ledger, but not in the banking system.
It's just an asset transformation on a bank's balance sheet. The cool part about what happened with what's going on in Europe, as people may or may not know, I mean, Rick Santori would have a meltdown but over half of those reserves are the reserves of branches of foreign institutions. So, right, when the ECB moved 3 months late by our prediction, but again, only continue the fuel behind the S&P, which was what we thought was there, or the upside was the ability of them to move those reserves from, let alone zero, to a negative penalty, right, to the U.S. system. And that creates a great upside potential for the stock market here. And those institutions can lever up. I mean, right? I mean, the Fed is actually supporting the levering up of the European financial system.
Yeah, and can you imagine with what the New York Fed just came out and said about Deutsche Bank and the risk controls or whatever, but at the same time they're going to increase their payment on excess reserves. It's just baffling.
Let's pay them 4%. Let's just take the Taylor rule. Forget about the trip from 0 to 4, or the 25 to 4, right? Which is, and again, to get into the sewer with this thing is why once the term structure returned to where it was, and this became more evident, it was my advice that they cut the rate to 12. See, and then they could have flattened it out at the other end, but they would have lost the spread. So to the Death Star. So they actually just embedded the spread between the two.
Yeah. So if they would cut interest on excess reserves, and where basically banks, it was a break even, right? Because of their FDIC fee or whatever. Then would you then kind of see how much leakage would come out of the banking system because the banks would just let it walk out the door?
Yeah, well, that was my feeling. At least you could have observed it. But
yeah,
to try and push them out, is trickier. And again, not to get too lost in the weeds, but this is what people are not discussing when they say, "Oh, the Fed's going to hike in the first quarter," and so you really have to make the case of why or how that will take place. How will it take place? Why would it take place? First of all, when the Fed, in fact, has created enough stability to let these things roll off, which was the other thing that we advised was why taper? The market was ready for more. They should have cut half of what they were buying in the first stroke, and they'd already be done.
Yeah.
But they're still, we're only getting to 0, and we're already talking about how they're going to roll off.
Yeah, I think that they've demonstrated that they're pretty afraid of their own shadow when it comes to, what the market. I mean, I think they feel like if they sold mortgages, mortgage rates would shoot up, however much, 100 basis. But I mean, the market's going to go where the market's going to go, based on where the demand for the credit is. I'm not one of these who believe that. I mean, you may have a short-term blow-up event, but when it all shakes out, I mean, look what taper did. Taper is a perfect example. It shook out, and it's the same spot. I mean, I think ultimately, if they were to reverse and start selling, then I think you'd see the similar response. See a big move at the beginning, and then it would probably just absorb it all. It's kind of like
7 months of stability has never given more people the worst case of the EBGBs in credit history.
Funny how that works.
So I guess we ask the next question is, should you care about the rest of the year's tapering process, and if they happen to do $15 billion next Wednesday or the meeting after that rather than $10 billion? I suppose you just kind of answered it, Vince, with the last question. It might cause a short-term event, but in the long term, it's probably going to revert back to where it was.
I think the only risk, and this is not something that I have any experience in, but just what I obtained from listening to conference calls, especially the REIT guys talk about this, as you know, Mike, is that when the Fed is finally out of the mortgage-backed security market, that there's some, I think Jody Shin wrote an article about this from the CYS guys' comment, is that there's a lot of speculative money just playing this specialness in the role that have no intention of ever taking delivery on any actual mortgages, and the Fed's been absorbing all the delivery. And so once the Fed does stop absorbing 100% of the supply, the deliverable supply, new issue, that you could see a little hiccup in the back end, and that's probably, in terms of taper risk, that would be what I would maybe be looking for. But I think there's a lot of people that are looking for it. So
yeah, I mean, because it seems like every single, all the calls from the last 2 quarters for the mortgage REITs, they've all been talking about it. And
everybody's looking for spreads to widen when the Fed's done.
Right, and then as you've brought up with the 15-year MBS, it seems like just about for every mortgage REIT and every bank is hiding out in there, and there's not that many out in the long end, 30-year, 20-year. It just seems like it's the wrong thinking. It's the inverse thinking. Should be playing the opposite.
Yeah, you'd think they'd be piggybacking the Fed.
Yeah. Right. If I was at the Fed, I'd say, hey, we've artificially suppressed and compressed these spreads. Please be kind when you put them back in order. Once we're done. Well, the taper showed them the market's not kind at all, right? But we're not going to do that twice. So, I believe in the big cycle. The higher and wider is still where we're going. The difference is it's 6 months later and we're not there yet. All we've got is an adjustment in on the curve. And so if there's something that I'm worried about, or I think was from a trading standpoint could be taken advantage of, it is in the 16, 17, and 18 Eurodollar part of the curve, or those type of bond structures, note structures, where people now have confidently or reluctantly or been forced to go embrace. I think that the economy has more underlying strength in it that's going to keep manifesting itself for the time being than would allow me to confidently own that stuff.
So I suppose the next question I should ask, which is the new neutral, if you even want to talk about that, which is these Eurodollar futures out in the long end, which is, I believe, the golds all the way out there, that you would want to buy those if you think the terminal rate is going to be lower than 4%, which is assuming that we have 2% inflation at the end of the cycle, and then with the rules are 2% real rates.
Yeah, well, Paul McCulley's a friend of mine, and I've had a lot of good times with him, but if I try to have that position, I wouldn't be able to sleep. I mean, that's just more confidence in a concept that I'm willing to bet on. I mean, these things are violently, they reprice, they don't necessarily trade, and there's very few people that are willing to take them off your hands when you need to reprice them. And so I don't believe in the old normal, so I certainly don't believe in the new normal, and let alone the new neutral. I think that those philosophies are promulgated over the short run to justify short ball positions. Then again, as I wrote about in my blog a couple months when they started promulgating, was you make money 364 days, then you blow up. So
it's just confirmation bias for their position.
Yeah,
just kind of how you look at it.
I just I can only speak to my own experience, but there's whether it was the Y2K ridiculousness or long-term capital management or any other left field crazy thing that ever happened to those futures forward term structures, the precursor to all of them was the confidence with which the people were buying those colored things. And all I could say to the general viewership is, don't. You know what I mean? They're just nasty, dangerous, and the way people have embraced them scares me.
So we have a few charts from you, Kevin, that we could talk about. The first one you sent me earlier is about China's total credit versus their GDP, and if you have some comments on that you want to talk about.
Well, yeah, this kind of speaks. Pritchard put this out. He's a big following of hard money people. That's not where I come from. Obviously, I live in a fiat world. So, but again, this was really just, if you look at the growth in the debt over there, as far as, again, why do people continually think that the next problem is going to manifest itself right here in Uncle Sam's backyard? We've had our time in the sun, and I just don't think that the risk profile that people should be worrying about is coming from the United States government or the Fed's posture, calibrated posture. But certainly I'd keep an eye on this one, because they're getting to a point where their ability to paper over, they papered over some fairly sizable potholes. The next, I think you could have something from them that is more meaningful.
And that's something. And to me, the fear about China is that you're not going to find out about it until a couple weeks after it happens, right? I mean, it's going to be because
you're three or four. I think you're 3 or 4 counterparties down before you realize.
Right. It's kind of like this. It's kind of like this repo fraud going on with the metals. I mean, how many layers of the onion you got to peel back to find where the bodies are buried, so to speak.
Right. So again, you got to be Jim Sanos to be able to time the ability to borrow money and short the thing. But that was just why is everybody so worried about us? That type of chart.
And I suppose we have a few more charts, but if you have any questions, just send them in to us so I can ask Kevin and Vince. So we have a few charts here of the Hooper model, and if you want to go through that, Kevin, about what that is and how it works and your service. I mean,
this is what Joe Avicito and I, Trading Points and I, developed as far as, again, now you go from the macro to the micro. I already have all my biases and opinions about the world. I just have to know when they can be, I think they might be actionable. So I've created a mathematical, as opposed to high-frequency trading and worrying about that. I always speak to people, I call myself a low-frequency trader. And so if you look at the 10-year, the reason I put this today was from a sell standpoint or trying to short the market. If you look where we have that point right there at where the red arrow is, it's 125.04. That small move right there, that shows you how tight the market's been, but that's basically the tradable range from today. And so I think that, there was some buying at the close, but as far as I'm concerned, the market should be marking down. Now, this is just a way for me to be actionable in the market based on mathematics as opposed to charts. Joe understands charts. I don't speak the language, so it's just kind of what people that see, if you look at what we do on the Contrarian Corner, this is what the basis of it is. And if you show the other one, the weekly, Joe's done a lot of work with regard to us trading the S&P only based on weekly. And we were able to develop fairly significant outperformance from buy and hold, even in an up year like last year. So that number right there, if you look at 1964.50 on the S&P, that's you pretty much know where we turn on the market.
Great. I have a few questions in here. If you guys like to answer them, the first question we have is there's a lot of comparisons to where Germany's 10-year yield at, which is about 1.15% right now. And if you adjust that for inflation, with real rate, that's about 0.4, and it's about the same in the U.S. with the 10-year today is 2.5, and last month's inflation was 2.1. So it's the same real rates, and so it's neither is really cheap to each other. If you guys have any, because it seems to be often something that's discussed frequently is Spain or Italy at 2.5. Yeah.
This goes back to what I kind of say about the inflation risk premium. So and we kind of touched on this earlier. You have one central bank that is trying to inflate the currency, and presumably they're overtly doing it. I mean, not presumably they are, but and you have one central bank that's basically saying, okay, we're stopping. We've stopped the increase in excess reserves. So if you're China and you've got do you want to own dollars at 2.5 or euros at 1.15? I think that's the choice, right?
Right, and I think that this speaks to exactly what we were talking about prior, Michael, was that for me, the question that is embedded in that analysis is like, why do we all believe they're supposed to be somewhere else then? You see, or to the extent that we do,
yeah.
Right? We still are calibrating, or the way I look at it from a big cycle, we tend to either bring a bias or calibrate normal. This is why Taylor's wrong about the Taylor rule for Fed funds, right? It's let alone that it's calibrated the data that's too old by the time he inputs it into his model.
God forbid they legislate that, right?
Right. So what we're calibrating to is a phenomenon of the 70s in the United States that, as I said earlier, if I go back and look at interest rates, Sidney Homer's history of interest rates back to the Renaissance, that's the anomaly. We're calibrating to the 70s, right, explosion, and 80s and 90s slow mean reversion of an anomaly in the United States. And what this is, and where the new neutral gets some of its support, is the recognition that we have returned actually back to the structures that existed before that incredible blow up.
Well, look, let me ask you this, Kevin, because I think that begs a point. And so, under the old regime, or the returning to the old regime, should 10-year be nominal GDP? Should it be inflation? Should it be a premium to one of those two? I mean, where do you think that? Because we're not talking about level. We're not saying that the 10-year should be at 2.5 because it was at 2.5 in 1900. We're saying the 10-year should be at 2.5 or 3 because that's where the level of growth is.
Right. Yeah. Now, the only thing is I want to get rid of QE for that reason, because I think that it should be the 5-year, as you guys know. You've spoken to me before, right? But the 5-year, the track record of the 5-year continues to outpace these other things on a real basis, right? Even from last year, right? They're like, oh, well, it looks like it's right. The growth rate did adjust to the 5-year, right? We were just overestimating the growth rate.
Yeah.
And so again, this is why I talk about why would the Fed be preemptive? Why would the Fed raise rates in the first quarter? Make the case, right, to show me where the market even manifests the slightest concept. Now, don't get me wrong. I'd like to see us move in that direction because I think the growth rate is good enough for that. But to the extent that they need to adjust their policy to a 5-year note at 1.5 instead of 2.5 is I just don't see it. And they're certainly not going to be the first to act. If the market can't price it there, right, at least when they're done LSAPing, you will no longer have people in the media promulgating the idea that the Fed is artificially holding the rate down, because they're not. And so when they're out of there, we'll at least have to move on to different concepts of why it's here.
So I have another question. This question is, when do you see the 10-year? It's been in a range of about 2.5 to 3% this year, which it's breached it on either side by a little bit. Do you think it can go below that range or above it? And if so, roughly how long? I mean, we're not going to try and time it here, but yeah, like just a general outlook.
Yeah, well, my outlook's not, I mean, I was going to say above it, but, I'll know when it starts to fall.
Yeah.
But, that's my opinion. Yeah, I believe in the secular bear market in bonds. That this is we are living the protracted top. We're in year 2. I mean, is it going to be 4? I hope to God not. But that's, you know what I mean? But that's more hope for people that are going to attempt to day trade it, right? Because the opportunity will not be there for you over that next, right, if that's the case. Those opportunities are drying up for most of these people this year because of that, right? But, yeah, that's what I believe. And the real question is where will it go to? We're certainly not going to, in my opinion, after the taper change, I'm going to create unless there's some outside and some crazy return to 70s, right? And this is what I mean by the bond. Look at the damage. Look at the stop that the bond market the futures was able to put on the concept in the taper tantrum. Those things didn't exist before. Those products didn't exist before. And so the ability of a central bank to create inflation, even ours, in an environment of these type of derivative contracts is much harder now. And that's what we're finding out.
And so just to elaborate, and by that you mean, say, the Eurodollar future, that's the 6 Eurodollar future, which is about a year and a half out, that goes from 50 basis points to 150 basis points in about 2 weeks, which
right.
That tightens for the Fed ahead of it. It doesn't even have to tighten because the market already did 4. Just wanted to clarify. Yeah, okay.
Exactly. And so, and there was economic consequence of that move too that we saw, obviously. And, and that's what concerns the Fed, is that we were getting, but so now it's out of the way, we can walk, they can slowly, right? And again, if you're going back to calibrating policy, this is why Vince and I believe that the rest of this is hype, that the Death Star is a wimpmobile, and they're just going to keep trying to walk people towards the door while they just slowly roll off.
Yeah, I mean, I think to Kevin's point that there's way too much focus by the market in trying to price the 10-year based on where they think the Fed is going to move the Fed funds rate in sometime in the future. And everybody's like, oh, the 10-year, everybody's wrong because the Fed's going to have to hike earlier and they're going to scare the market. And I'm like, well, I'm thinking to myself, the bond market is not stupid. I mean, they're not sitting there and saying we don't believe the data or whatever. I mean, I think that and this is why I kind of harp on mortgages. I think it ultimately comes down to, is there going to be any supply of mortgages at 4%, a 30-year mortgage rate, which is a 2.5 10-year, and if there is, the 10-year will start to reflect that, and the yield will start to move up. And I think, ultimately it's very similar to it's a commodity, right? Interest rate's a commodity, so it's a self-correcting market. And interest rates will go up if the demand for money is increasing, and the demand for money will increase, probably when wages start to pick up. So I think, but the market's going to move first. I mean, everybody acts like the market is waiting on the Fed, and I just don't believe that's
right.
True.
Yeah, if you put it in terms of populist CNBC ranting commentators, I would say that the Fed's behind the curve. Well, the curve, no, they're not. But they will be by the time they act.
Yeah, right. I mean, when they finally do move or respond to economic conditions, the curve will have already moved. Isn't that what you're saying, Kevin?
Absolutely.
Yeah, I mean, they're not. The bond market is not waiting around for the Fed. I don't believe that to be true.
Not to have them hike on them and get caught out owning a bunch of stuff out there. There's no way. And so until then, you get the stability.
Yeah. But I do, to the extent that economy continues to improve, and I don't think there's any question that it does. And just because I may be cynical or bullish on the bond market doesn't mean I don't recognize that the economy is doing well. But I also recognize, and I think Kevin, you may have commented on this yesterday on the Twitter, is that it's not quantity of jobs, it's quality of jobs, and the wage picture I think speaks to. I mean, you can go out and get a job right now if you want one. The question is whether or not that you're going to get paid, and what are you going to be doing?
Yeah, I mean, I think the unemployment rate, to speak to the local economy here in Napa, is 2.
Yeah.
2. Well, it doesn't matter. I mean, these people can't even. They need to work 3 of those jobs to afford a house.
So this is a question for Vince. At the beginning of the year, you said one of the most important things to watch is going to be the yen. Do you still think that now? And do you have any thoughts?
Well, I mean, who likes to be right for the wrong reasons? I mean, the yen's basically sideways, and so are interest rates, right?
Right. It's true, because if you look at the dollar yen, it's since February 1st, it's traded in a range of about 2 points, if that.
Yeah, I mean, I would not have bet for it to move sideways. I'll admit that. But I'm not a currency guy, but I just I kind of feel like the dollar should be strengthening, and I would rather look at the yen than the euro. I don't know why, but I don't know. To me, the euro is a little bit overlooked at. But the yen, to me, the dollar should be strengthening against the yen as the Fed exits stimulus. And maybe that's the trade that we're not focusing on right now because we've been lulled to sleep by it. But when as reserves start to decline, the dollar should increase in value.
Right, and then you might see those real rates shift away from each other.
Here's a question. Is there anything that you guys look at within the market to see if the market is overly bullish on long duration? And by long duration, I mean
besides the Twitter feed.
Besides the Twitter feed.
It's not TLT comments.
Besides Bill Gross's Twitter feed.
Oh goodness.
Yeah. No, it's kind of like pornography for me, or what was it? Warren Berger said that, right? You just know it when you see it.
Yeah, I tend to kind of I tend to look at the mortgage spread, and if mortgage it's really telling me something. For instance, if mortgages are outperforming in a rally, then then that there's some duration grabbing going on. And the other thing is as I pointed out in the last article, is not something that I pay attention to, but I was when the 30-year hit 3.25, I was like, well, you know what? I wonder where the 30-year zero has done over the course of the year, and I was shocked. It was up like, what did I say, 30% or something.
Right.
And you're not hearing that from your financial advisor.
Yeah, 20-year zero is up 23%. It's pretty darn good.
Yeah. So there's your duration.
Right.
And you got guys like Jeff Goodlock out there talking about buying he's got inverse floaters and all sorts of crazy, stuff that he's buying that's long duration, like 18 years and such. But, the risk, I think, in the duration part of the curve, in the long part of the curve, is how much leverage is out there employed to own the duration. And are the borrowers or the buyers, the levered buyers, are they repo buyers like they were in like the REITs? I mean, last year the taper tantrum, a lot of that was levered investors in the repo market that got blown up. Or are they a little bit more, are they insurance companies? I mean, to me, insurance companies, obviously is a little bit more stable money, can afford the duration and not as price sensitive. If they're hedge funds or mortgage REITs that are levered up 8-to-1, then that's when duration can get a little bit scary.
And I have one question for Kevin, and I will not tell you who asked it, but what is your price target for gold?
Yeah, I don't know. Yeah, obviously somebody heard must have heard when Benzinga called me or whatever. Yeah, it's the wrong guy. When someone says where are the golds, I'm still looking at the Eurodollars.
That's right.
I have no idea where the metal is. You know, maybe oil. We've had a nice trade down in oil in the front and corn too. But yeah, I have no opinion, nor do I know where it trades.
So we've run out of questions. I have a few questions. They're a little bit complicated, be a little bit difficult for me to ask them. I will forward them to Kevin and Vince. If you guys have anything we didn't talk about today that you want to just
I'd like to bring one thing up that I think might be something, guys, the listeners want to keep an eye out for. You know, we got a Fed meeting next week, but it's not, as I understand, it's not accompanied by a press conference. Is that right, Mike?
Correct, and there'll be no projections either.
Yeah, so that leaves the next big communication for Janet Yellen. I'm assuming she's going to talk at Jackson Hole.
Yeah, I think she's going to be chairing the last day, but I don't know if that's official yet.
So, I mean, to the extent that the Fed wants to elaborate on the mechanism for raising interest rates, I think Jackson Hole, which has proven to be one of their main communicating venues, which I think is typically at the end of August.
It should be the second to last week of August. That's what it normally is.
So that it may be quiet until then, and the guy used to kind of brought me up in the markets in terms of technical analysis used to always act like while the boys were at the Hamptons, it stayed quiet, and then when they came back after Labor Day is when things started moving around again.
So no doubt.
And
if she's smart at Jackson Hole, she'll just say, "Mr. Draghi, you have the floor."
Yeah.
And I guess I could ask this question. It was asked of me today. We have next week. We have GDP, NFP, FOMC. I think those are the three really big ones. As far as where do you think they'll be? I mean, this is I'm sure it's just a guess for the most part. And with GDP is going to clock in at flat for the first half, real GDP, more or less, and nominal GDP will be very low 3%. Do you think that's going to accelerate in the coming quarters? Because it seems like that's the call, the gist.
Yeah, I'm more constructive. My advice, or what I'd like to see happen, as I spoke before, and some blogs, is that we want to move away from focus on the only volatility day, right, being unemployment. And we want to see the volatility day come back to ISM and retail sales. And as that it's happening a little bit, right, you still get an incredible amount of fear and hype leading into it. But if you look at the last 3-4 unemployment reports, they were actually, duds, 2 of which were deemed in the media the most important number of the year, right? And so I think that the idea of a healing economy, or an economy that begins to look forward as opposed to evaluating it as in terms of the crises, is a market participant that focuses on ISM and retail sales instead of employment.
Or would you be looking more at services or manufacturing, or do you put equal? I mean, obviously there's more of a services economy, but
yeah, I just don't know how accurate or how truthful they are about that. I mean, obviously, it's you watch it, and it's actionable from a trading standpoint. But when you talk about even some of the sub indexes, I like to watch Milwaukee. You can watch New York, obviously. I think those are really truthful
and you've always told us that Chicago is reflecting the auto sales, right?
Yeah, it's a little tight to auto, but I guess in general what I'm saying is that the responses are given by people who are still very, very reliable in their interpretation, not just of what's going on in their business, but their outlook for that business. And so that's why I continue to watch those numbers. And you've got an employment component, I think, embedded in them, so that they give you both. But, when you talk about volatility days, in other words, right, so unemployment has become almost worth 4 days of implied volatility. Well, in a 20-day stretch, you're talking about almost a quarter, right, of your month is, from a volatility standpoint, revolves around one of the least important and, poorly tracked numbers, right? And then everyone just debates it. So, I like to focus on the other two, and yeah, my general view is I'm more constructive than most.
And we just have one last question because it's getting a little late here. And this just regards to the Humphrey Hawkins testimony, and I believe there was some Congress people that asked if the Fed should go to a rule-based guidance where they should use I believe it was even asked of by the IMF, where they should use the Taylor rule as a rule for policy, which seems a little bit off to me.
Nightmare.
Yeah, it's a nightmare.
I mean, the Fed's got enough flaws as it is. I mean, to legislate a rule that commands their interest rate movement is insane to me.
Yeah, let alone one as flawed as the Taylor rule. But
yeah, exactly.
Yeah, that would be a thing that could lead to a major miscalibration in policy again, like the 70s. I don't see it happening. I mean, the number one policy tool that the Fed has implied since the crisis, and their most effective, has been their flexibility. Period. For all the criticism and all the people that think they were doing the wrong thing, their flexibility has been their asset. And so to give it away, I think it's insane.
Yeah, that's a great point.
All right, well, I think that wraps it up. So thanks so much, guys, for hopping on this call today. And for everybody listening, we did record this, and we will be sending the slides around tomorrow when it's available. And Vince, Kevin, thanks a bunch for hopping on.
Yeah, thanks for having us.
Thanks a lot. Thanks a lot.
We'll talk to you in 6 months?
Yeah, about 6 months from now.
All right.
Have a great evening, everybody. Thank you.
Too.